This is KTN News.
The Nairobi Securities Exchange is one of the leading securities markets in Africa. The NSE offers a world-class trading facility for investors looking to gain exposure in Kenya's economic growth. Invest in the NSE and start your journey to wealth creation and financial freedom. For more information, visit www.nsc.co.ke. The NSE. Discover opportunity.
A very, very good afternoon. Welcome to the Trading Bell. My name is Malika Kazia. Joining us today is the Derivatives Market Director, Terrence Adembesa, who'll be talking to us more about the derivatives market in Kenya. Definitely an exciting conversation coming up. But before that, let's take a look at Terrence Adembesa's profile.
Terrence Adembesa is a Derivatives Market Director. He has over 10 years' experience in investment banking and notable achievements in financial sector engagements that have and continue to impact directly on the lives of ordinary Kenyans. Prior to his current role, Terrence was the manager product development at the NSE with key responsibilities in driving business, the development and implementation of new products and markets, and the management of information services. These have included the Growth Enterprise Market, the NSE and FTSE International Index Series, and a suite of products, derivatives market, real estate investment trust, and the exchange-traded funds. He previously worked in corporate finance at the Merchant and Investment Banking Division of the Cooperative Bank and at the Enablis Entrepreneurial Network. He is a Global Executive MBA graduate from USIU and a BBA Management Honours undergraduate from the University of Eastern Africa, Baraton. Terry has attended various capital markets and securities industry certifications.
Welcome back to the Trading Bell. Of course, with us is Terrence Adembesa, who is the Derivatives Market Director here at the Nairobi Securities Exchange, joining us to talk more about derivatives and demystify this perhaps for a lot of people who want to know more. Welcome, Terrence.
Thank you very much.
Thank you for joining us.
Thank you.
Now, to start off with, of course, I would like you to just explain what derivatives are for those who are a bit confused with this term.
Oh, okay. So a derivative is a product that derives its being from another product. Mm-hmm. So stock index derivative would derive its being from the index. A commodity derivative would derive its being from an underlying commodity product. So it could be a coffee or a maize contract, and the underlying, of course, would be a bag of maize or a bag of coffee. So a derivative product derives its being from another asset product.
So the value is, of course, generated from the value of another commodity, essentially.
Yes.
Okay.
Yes.
Now, you know, we do know that, of course, the NSE received approval for the derivative market in 2015 from the CMA, and recently you received approval for a pilot phase for the derivatives market. Now, it's been about 4 months, I understand, since the pilot phase was launched. And could you explain to us the progress on that pilot phase?
Okay. So the initial stage, phase one of the test phase, was to involve 6 trading members and 2 clearing members.
Yes.
Who are banks. And it involved trading of equity products, equity derivative products, over a period of about a month. Market simulation. It was on simulated cash, not real live money. Mm-hmm. And this went quite well. Members were able to place trades. They were able to trade amongst themselves. At the end of the day, we were able to close the markets. We were able to send out end-of-day reports. And then, the clearing and the settlement run would run on T+1 basis. And that went quite well, and we were happy with phase one. We shared the reports with the regulators. They allowed us to proceed to phase two. Phase two entails trading of live cash. So the trading members have put in some cash which they're trading amongst themselves. And it's the same thing, trading equity products, derivative products, which includes the index, includes Safaricom, includes KCB, Equity, BAT, EABL, and one more, DTB. So basically that's what's been ongoing. We are in the second phase. We are in about 1.5 months now. There's still another 1.5 months to go, and then we can close, then go back to the regulators for final sign-off before we can launch the market.
So I see that you're taking it gradually so as to also test the market and to see how well it does and for different things. But what derivative products are the ones that you're using in the pilot phase specifically?
So in the pilot phase, we're using the index, the NSE 25 index, which is also the same product that we will propose to launch. And then we're doing single stock futures on select counters on the exchange. These have been selected based on some criteria, which one includes some certain level of liquidity that we've tracked over the last 6 or so months. So these are Safaricom, they are Equity Bank, they are KCB, EABL, BAT, and Kenjan. So those are the only 6 counters that we'll begin with for now.
Okay. Yeah. Now, I understand that it's been some time, of course, since the derivatives market has been an ambition for the NSE.
Yeah.
And I think one of the other regions in Africa that has successfully been able to do so is South Africa.
Yes.
Yes, and in fact, from the 1980s around which the SAFEX was introduced, now they've become one of the leaders.
Yes.
And what kind of lessons can we learn from South Africa in terms of policy in order to implement this successfully here?
Okay. It's mainly around two issues. Of course, the first one is around investor education. So a lot of work needs to go towards investor education, both on the retail and the institutional investors. The ability to understand those products and to be able to trade them, how they trade, how they clear, is the most important aspect in everything.
Yes.
Secondly is the participation by market players, whether they are the trading members who are able to trade their own book, right, or the institutional investors, your pension schemes and that kind of thing, the ability for them to trade. As it is right now, we working with the Retirement Benefit Authority, got through the policy amendments to allow for the trading of derivatives, the participation into the derivatives market by the pension schemes, up to, I think, an amount of about 5% of the assets. So that has been approved by the regulator. That's key, that's critical, because, again, institutional investors bring in a large chunk of participation, especially in the local market.
Okay, that's interesting. So now that we are talking about investor education, I suppose it follows that my next question would be, what are the advantages, of course, of derivative products being in the market?
The main one, of course, is on risk management. The ability for an investor to be able to take a hedging position on their investment, and that's going to be the main and the biggest incentive for investors. The second one is the ability to trade an asset based on margin. Currently, if you're to participate in the stock market, you have to put up the cash upfront, the full amount of the cash. But if you're trading on derivatives, then you're able to trade based on margin. And that's one of the other incentives, especially for investors who would find that they would want to, use their cash or their securities to trade a bit more of other securities.
Okay, and as you see, that is one of the greatest advantages. But what sectors do you think are best fit advantage of such risk management benefits that the derivatives bring? Like, I know for agriculture especially, because having the kind of knowledge and that empowerment that we know this harvest will turn out this way is not always there. So what are some of the sectors that can most take advantage of the derivative products?
Of course, the investment sector, so your pension schemes, your fund managers, your asset managers, would be able to benefit greatly from equity products, equity derivative products, and when the time comes, from interest rate derivative products, because they're also the investment portfolios, invest into debt securities. So the ability to hedge on movement of interest rates is key for them. Of course, then going forward is on a currency space where you have corporates with foreign liabilities, and they would want to monitor the movement of the local currency against other key global currencies. The ability to hedge that will be key. And ultimately, of course, is people involved with commodities, whether you're agricultural, agricultural sector, or your transport sector, because then they're able to hedge the price of the underlying commodities that is critical to the businesses that they do. So your maize farmers, for example, will be able to use derivative products to ensure that they are able to ascertain a price for their product even before harvest. And your transport sector would be able to manage the risk in fluctuations of oil prices, before they can actually procure the oil. And I guess gradually many aspects of this economy would then be able to hedge using these products.
So clearly it has benefit for a lot of sectors across the board when it comes to hedging. And now let's get back to the pilot phase. I would like to know what some of the key milestones and developments that you noted since the pilot phase was launched, as well as some challenges that you have identified and can possibly work on.
Okay. Of course, the first one was the ability for a full trade to go through. And this starts right from onboarding a client, the client depositing some cash, the cash being passed through from the trading member to the clearing member. There's some files that need to go through the trading member to the clearing member and to the exchange. Once there's a reconciliation of the cash and those reports, the investors can then trade. So once the trade is matched, then at the end of the day, the exchange needs to run an end-of-day process and send out reports to the market players. The market players are supposed to reconcile back to the exchange to show that this, all our positions match the exchange. And then at the end of the day, we also send out a price file to show that this is where the prices were. So even market players are then able to market their positions. Then we're able to tell who's made a profit and who's made a loss. Unlike in the spot market, the profits and losses are actualized on a T+1 basis. And so you'd expect that your profits or losses the following day are either credited or debited from your account. So on T+1, the day after the trades, we then would need to monitor that actual flow of the loss position to the profit position is done, and the flow of cash happens, and that has happened, and we are happy that that is happening. And so gradually, on a daily basis, is to repeat that, and participants to be comfortable with that process. And we're happy. We're happy that that has gone well.
So essentially, it's come full circle.
It's come full circle. Initially, there were delays, slight delays in sometimes dispatch of reports or that kind of thing. But this has since been rectified. All players, whether it's the exchange or the clearing members or the trading members, understand what timelines need to be met. And that's happening very well.
Okay. Well, that sounds encouraging and definitely something very productive, as we've seen through the pilot phase. And finally, just to wrap up, should Kenyans expect a full market launch next year?
So what happens is that at the end of the pilot phase, of this pilot phase we would need to, just do some reports and send back to the regulators for sign-off before we can launch. So far, working with the regulators, they're happy with the progress. So we don't see any major concerns coming out. And definitely, we then would look forward to, Q1 go live for the market.
All right. Thank you very, very much
Thank
for
you
that.
very much.
That was, of course, Terrence Adembesa, the Market Director of Derivatives here at the Nairobi